We recently celebrated our 5-year anniversary here at the Art of SBA Lending. That's 5 years of providing unfiltered, expert advice to small business lenders, and that's earned us a lot of trust with our listeners, so much so that they call me for career advice. Now, I know there's also a lot of leaders throughout the SBA industry who are constantly looking to source great talent, and that's why we created SBA Jobs Board. SBA Jobs Board connects hiring managers of the SBA industry who are actively searching for their next great hire with my highly engaged audience of SBA lending pros. The SBA Jobs Board is live right now on artofsba.com. If you're a hiring manager, you can go in and post a job for just $99. If you're listening to this and you're ready to start the next chapter in your career, go check out the available positions. Visit artofsba.com for more information. Hello and welcome back to the Art of SBA Lending. We're kicking off our Vegas series today with a very special guest. I went all the way to the desert to interview my old pal, head of SBA Lending at Bankwell, Michael Johnston. Michael and I worked together at Ready Capital, and between the both of us, we were there for a total of 13 years. That's got to be some sort of record. We got into some of the good times and some of the hard times throughout that journey. And then we look forward because Michael recently left Ready Capital to pursue his next challenge, running a shop. So I asked him how that's going, how he knew it was time to leave, what his vision is for the new shop. And then we went into some of the challenges that we all face when it comes to building and scaling a 7A shop in today's environment. So without further ado, here's my conversation with Michael Johnston. With all the demand for SBA skilled people, why in the world would any SBA professional who's worth their salt need a recruiter to help them land a job? Well, do Tom Brady and Michael Jordan have agents? Exactly. The truth is, the value of a vested partner in your success, someone who will work to learn your story, your priorities, and your values, is immeasurable. The team at Baker Lewis has over 30 years experience helping SBA professionals think strategically about how to make the best move possible, and helping SBA lenders think strategically about how to build their teams. In the last quarter alone, Baker Lewis has helped a new SBA lender staff and launch its small loan program, helped the number one BDO at a top 10 shop find a new home and get a great deal, by the way, and placed a junior servicer and more. Look, we're in a bit of a wonky market. It's easy to make a mistake. You can't rush this stuff. This is your career. These are your people. Schedule a call with Baker Lewis today and begin the process of finding the best possible opportunity for you. We'll leave a link in the show notes. You know, I was thinking the other day when we were at ReadyCap, the early day, like probably the year one, right? You came in and we used to go up to New Jersey every like February, right? You remember, you were there for some of those fun like little times we had, right? With those.
Got stuck 2 or 3 days later.
Oh, yeah.
The Northeasterns would come in and yeah.
It's horrible timing. But like we would like all hang out in like a little restaurant in the corner of a restaurant or something and like get beers and order pizzas and stuff like that. Wasn't that fun?
Yeah, because that was also the one we had the downstairs. They had the whole bar with pool tables and different things that people would hang out. That's the one I was at when we go to those yearly. Mm-hmm. Because I think I was at Ready Capital 6 months before I ever went up to corporate. That was I went to the very first event.
Interesting.
That I had ever been to.
No, they didn't bring you up for like an orientation or anything?
No.
Now, a lot of people are doing that now. It's like crazy. Like, oh, it's the first time I'm meeting people and they're in it for 6 months. I'm like, I don't know. It's tough. But when your whole team's remote, I mean, there's no other way to do it. I mean, at least there was like a home base with like.
Correct.
And I liked going there because half the team was there in New Jersey at the time. So it was kind of like we brought in a bunch of energy from this because the sales team was all spread out and I was kind of getting energy from the rest of the sales team. It was pretty cool.
Well, and also, as you know, I mean, we had the row of here's underwriting and then the group of closers. So you could go up there as a salesperson and kind of hang out with them and listen to them and hear the stories and that kind of stuff. So it was kind of nice to be able to be part of that, like you said.
Yeah. And then COVID messed it all up.
That's right.
And then there was just like 50,000 feet of office. Like that was empty.
And like you said, we had that office space early on that was huge. And
Right.
then we
That was
even
huge.
downside to the next one. And then we end up subleasing out or getting rid of over half of it. And still, it was by the last few times I've been up there, it's not that many people.
Dude, you were there for over 7 years.
Yeah, almost 7. Yeah, over 7 years, going on 7.5.
That's crazy.
Yeah, it's my second, or really my longest tenure at any one shop.
Yeah, I
throughout
saw
my
that.
career.
You beat me. I was 6 years.
Yeah. Because otherwise, I'd been one other time I'd been with another place. We'd changed and got bought out a couple of times, but the difference, it's an evolving thing. I mean, as I would say too, for me as a manager, hiring people, when you start to see the resumes of the salespeople and how long that they are tenured at places, then you see somebody that's been someplace for so long. It's like it's really unusual in today's market for our industry that people are, more than 5 years at any given shop anymore.
I was going to say 3.
Yeah, 3's a good one.
Well, and you started as a BDO.
Correct.
And worked your way up to regional sales manager, producing sales manager, full time, basically ended up national sales manager overseeing the whole sales team.
Right. So it was a progression, and, I think I was blessed to have that opportunity. And, there was days that, we all talk about sometimes just being on the sales side is easier than being on the management side, but it really taught me a lot as a person. Made me I grew a lot at Ready Capital, I would say.
Me too. How did you know when it was time to leave?
I think part of life is about, when you stop feeling like, are you learning as much as you thought you did? And are you still having as much fun as you thought you did? And, for me, it was one of those things that it was time for me for new experiences. I was ready to take another leap in the next direction as overseeing a division or something. So I feel like it became time.
Yeah. So, yeah, I agree. So those are 2 good points. You have to be growing professionally or as a person, and you should have fun. This should be fun. If you're not having fun, what is it all? Life's short.
As you know, what we do is tough. I mean, it's not like we can talk about the fact that, I can bring anybody in and make them a great salesperson. But our industry has a lot of ups and downs, a lot of frustrations, not only for the client, but for us. And like you said, if we're not having fun doing it, to me, part of it was we're blessed with value add. We can actually help somebody create what they've always wanted out of their lives. That, helps give that blessing back to us. But at the same time, if we're not able to have a little fun along the way, it becomes a grind.
But yeah, I always say it's the hardest part of being a BDO is that there's just really high highs and really low lows, and you've got to self-regulate so you don't go insane.
It's a roller coaster ride.
It really is. So what's this new gig?
So I joined Bankwell. It's a publicly traded, $3.3 billion bank out of Connecticut. They've grown themselves, kind of doubled over the last couple of years. They had primarily been a commercial bank. Then they had got into doing some SBA, and they had acquired some banks in time, but they had come to the realization that, they wanted to do some small balance. Came to an opportunity where our paths crossed and said, okay, let's add not only small balance, but then also the large balance. So that gives me the ability to do transactions from, I think we've come to the conclusion, $75,000 to $5 million is kind of where we want to be. And so we segregated the two, where we have a small balance team or the large balance team. So the goal, how they see it is that, clients aren't able, or customers and individuals, business owners aren't able to get to readily available cash on the small balance. And the government and the SBA has been promoting that. So they see that there is a need for that. So, so they started with the idea that if we can deliver good service, with, meeting the needs of the client on their terms, then it could be a good opportunity. So the goal is to try to shorten the window of, it not taking 30 plus days to close a small balance loan, get something done in 2 days to 5 days is the goal.
Oh, amazing. Yeah. I mean, and we can do it. We can get there for sure. So when you start out, do you use an LSP when you first start out, or are you doing an in-house thing?
There's been a lot of discussions about both, and that it's a tough decision because sometimes you give up profit and stuff by using an LSP, but you also gain some of the expertise. The good thing is for Bankwell, they were already a PLP licensed lender. They had been doing loans under primarily insurance is where they were. So they have an insurance program that they're doing conventional. It could be an Allstate or Farmers, but a lot of theirs was independent. And then when there was a need for a smaller loan that would qualify more for SBA, they were doing those deals to the SBA. So some of the staff, they've had people that had been there and been at the SBA previously, and they helped create the policy, the credit policy. So I've come in, readapted that for more of a national platform, and being able to kind of take us to the next level from that, I hope. I think it's a learning process of what we're going through because they're still young in this, but at the same time, I think they have a desire to get money out the door.
How are you going to go find loans to do?
I think it's a combination of, I would say maybe a three-prong approach, in the sense that the small balance is driven by a lot of referral broker network, but there's also opportunity where, as you know, LinkedIn or other things that we can get our name out there and people are searching for, hope, some loans or whatever. Large balance is always going to be driven by BDOs that are going to be out there connecting with, brokers and, their own group of people they bring with them. But at the end of the day, I try to explain to people it's hard because large balance, most clients are one-time borrowers. So it's hard to find those that are repeat buyers in what I've come across. So a lot of it's just going to be us getting down on LinkedIn and letting people know that we exist. And that's what myself and Ryan Hildebrand is a big proponent of doing that, who's innovation officer that's working on that these days.
Okay. So how big do you want to get?
The goal is that, to start off slow, moderate, it's to crawl, run, crawl, probably this next year.
Not top 10 in 3 years?
Yeah, not to where we got. And I think you mentioned this on one of your podcasts, was that, compared to where we were, and you look at the top 2 or 3 and they're, pushing up $1 billion, it's changed. That idea of being in the top 10, that's a 500, I think, almost a 500 million.
I think we should just call it top 15 now.
Yeah.
Like
the reality is that, because you're right. I mean, it's not what it was, and so I think, doing 100 million to 150, I think is a very fair assessment over the next couple of years to do. To try to get to that 300 to 500 takes a little bit more effort, but it also takes the right staffing to get there.
You can do it just, slowly, methodically, year after year. I mean, I remember with going back to ReadyCap, I came in February. I think we did 20 million that year, 22 million, something like that. And then we went to like 50. Then I think we did 120. That was the most painful part, I think. And then 120 to 250. And by the way, I think, who was it? Gibson would always be like, get into 120 was the hardest part. It was all hard, honestly. Like, I don't know what he was talking about. It was all hard. But that's crazy.
And that's the thing too. I think people on the outside looking in sometimes think it's always easy to do another 100 million or another 200 million. But, somehow it's like the business life cycle. You crest over a certain point and then be able to get yourself excited and shoot back up again. It's not always easy. You got to have that, that culture. I think it's the key too. That's one thing I'm really want to try to build, is a good culture, because I think sometimes that culture, as you're talking about too, it changed on us. We were a certain culture at Ready Capital, then we grew, and then we brought in more people and trying to continue to keep that as you keep doubling up, not only in volume, but you're doubling up in staff.
Oh, it definitely changed a lot over the years. It probably just had evolved over and over. Because, I mean, originally it was so CIT heavy. Mm-hmm. They all went to First Bank of the Lake now.
That's right.
But you had that CIT culture, and then, everything just, Mosier came in. He, wasn't from CIT. So then, and then Gibson came in. He was from US Bank, and it just became a melting pot of all these different things. Let me ask you this. What kind of deals are you looking to do over at the bank on the large? Are you going to do like real estate deals, business acquisitions, generalist, industry verticals? Like, what are you thinking there?
So I think the bigger perspective is just being a journalist, real estate and non-real estate. My goal is to try to stay within like let's say an average loan size of $1 million. But I think the sweet spot's going to be, the old days that you and I were used to, that 750 to 1.5 million is a good sweet spot that we can, we know that you can make some mistakes and you're still okay. I don't think that we're going to be out there doing the $3 to $5 million business acquisition blue sky yet. That's just, I think that takes time, ability, and a good
That's smart
portfolio behind us.
Because if a couple of those go bad, in the first year, it's like a huge blow.
Or the bank's going to get nervous, no matter what. Yeah. So we have to do right by them, our stakeholders in this, but also we have to be able to know what are we looking at and why are we looking at that, and I think that, as the basic type of an SBA loan, in my opinion, in the last 10 years has changed a lot.
It really has.
When you look back to what we were doing, and what we are doing today, and can we compete on the real estate side, or are there some of our competitors offering fixed rates? Or the 504 has become, a bigger player, but I'm looking at just 7As for us. So it's, it's one of those things that it's a challenge. It's a challenge, that I think verticals are great, but I look at verticals as more of a subject matter expert. Do you know what a liquor store should look like? Do you know what a hotel, gas station, or a childcare center should look like? When you're getting better at that and you're helping your credit team become better at that, you make better decisions.
Yeah. If you've been a fan of the show for a while, then you know one of my favorite companies to work with is Rapid Business Plans. Last year alone, their business plans helped facilitate over $600 million in government guaranteed lending. They're on track to beat that this year. More and more small business lenders and their borrowers are relying on Rapid to help with the business plan, projections, and assumptions because their team goes the extra mile to ensure everything is done fast and done right. And that helps streamline the process. They're great at export business plans, by the way, which are critically important at protecting that 90% guarantee. Rapid also offers feasibility studies, which tells you if the project is, feasible. I would recommend these for any large startup loan because it protects you and it protects the borrower and helps you get more good deals done. Go to rapidbusinessplans.com to set up your Get Acquainted call today. Find out why so many top producing BDOs recommend Rapid to their small business borrowers. We're going to leave a link in the show notes just for our Art of SBA listeners. Now let's get back to the show. Going back to what we were saying with the kind of like scaling, I feel like you do, because you always want to grow. So I feel like you will continue to want to get bigger and bigger and build. But I feel like there's a point where it gets a little different, where you need basically more management in a sense. So to get to 150 million, this has been my thesis lately. Get to 150 million. If you have a credit manager or a director of credit, whatever you want to call it, and some underwriters, and you have a closing manager and some closers, and you have a sales manager. You don't even need a sales manager.
Mm-mm.
Just get some BDOs, and then the director is probably a sales manager quasi and running the program. That can get you to easily 150 million. But at some point when everything's going through the credit director or the closing manager, the volume gets too much. And then you have to kind of create leads and almost like this third tier of management. But then to do that, you have all this extra infrastructure that you've now put onto your bank and onto your P&L that you have to now race to 300 million or it doesn't become profitable.
And that's the challenge too, because when I was building my own budget, you start thinking how many staff that you want or need. I have an institution that I work for now that, for them to do the volume they've done and where they are, they're less than 140 people. So to think that, I'm going to sit there and think what a traditional SBA shop should look like, it's a challenge because it's not what they want to create efficiencies. So to your point, I look, even for as long as I've been in this and watched how things have changed, I think that technology and other things are going to help us get there without having to always add headcount. I think sometimes we, at the end of the day, there's certain things that can get done without one more person or two more people. And I don't.
People are saying that, but no one's really proven that out yet.
It's because I don't think the technology is quite there yet.
It's coming though.
Correct. In the next 3 to 5 years, it'll make another adjustment. Next 1 to 3, it'll be one level. Next 3 to 5, and then you look at the next 10 years. What is it going to be, compared to where I was 27 years ago when I started this?
So I think underwriters have the most risk of AI. So I think a credit memo. I think when an underwriter gets a deal, they're going to have a 90% complete credit memo waiting for them because we're going to extract all the tax returns and the financial data. We're going to put it in its place. It's going to automatically recognize the biggest year-over-year trends. It's going to pinpoint that. You're going to have to go and ask why this is the case, and you're going to have to kind of fill that in. That's kind of what the underwriter will do. But all the narrative will be in there, the industry analysis. It's going to be all this stuff that underwriters are taking a week to do. It's going to be there, and they're going to be able to do their job in one day, I feel like, with AI. We have robots and self-driving cars. How come we can't get a credit memo done?
Well, like you said, especially now that AI is able to scrape as much, Schedule Cs are still difficult, but the traditional, tax returns, business tax returns are easy to scrape and you can get some of the top things. I think it's just to your point is having somebody like when I looked at it as a manager, if somebody could go in and put the file together the way I need them to put it together, give me a synopsis of the deal, I can make a decision in 30 minutes. It doesn't take that long once, like you said, the basis is done. I think we overthink it in certain cases because we don't want to make mistakes. But, we live in a business model that no matter what, part of it is never perfection. No matter what we do, there's always things that it's a gut instinct. It's how I look at what we do when you're looking at a credit decision. Or is it a business decision or is it a credit decision? Sometimes from a business perspective, you take that risk. That's the one thing my takeaway for this last year and a half of where I was, we got to the point where it became a business decision. Sometimes it took on a little bit more credit risk, but we financially decided that this was the right thing to do.
Yeah. Well, when I was there, it was a little different.
Mm-hmm.
My portfolio was nice and pristine. I was like real estate secured up the wazoo, and the times are different now, and we were in zero interest rates actually we ended up getting prime to like 5.5 or something. But, you mentioned you wanted to bring in some BDOs to source those big deals down the road. And, coming from BDOing, BDOs. So what are you going to look for in BDOs when you're looking to hire?
For me, it's one of those things I go back to when I talk to a lot of people. It's about a book. It's called Grit by Angela Duckworthy. I find that those that are grinders, those people that are get out there and hustle and don't take every day for granted, those are the ones that you want. Those are the individuals that are successful. Doesn't matter if you're in your early 20s or you're in your 60s. If you're willing to get up every day and plug away, make the phone calls. I mean, you know how it is. You were always one that made a lot of phone calls. People, to me, BDOs can very easily get lazy. If you're not turning in deals, at least once a week or every couple of weeks, where are you investing your time? I want to find those individuals that they can be younger because it can be trainable. But how do I find that right individual that's going to get up every day and want to do better than they did yesterday? That's really what you're looking for, because the credit side of it can be taught. You can teach a little bit about the closing checklist and things like that to help push a deal. Conversational, we all get better in time. But how do you get that person that really wants to be better tomorrow?
The problem is most shops hire from the pool of existing BDOs, 90% of which just randomly fell into it.
Mm-hmm.
And I feel like there's different types of BDOs, to be fair, because there are BDOs that are meant to be more of Skinners, and they work at banks, and they're probably not even called BDOs, but maybe they are. But the good ones are very consultative.
Mm-hmm.
They have a customer that's brought to them. They will try to diagnose the problem and prescribe a solution, and that's fine. And then there's BDOs that are hunters, straight up assassin killers, like David Hewlett. But then there's all these other BDOs that just don't seem to get it. Like there's just different types of BDOs. So do you think you're going to go out and find people based on their personality, their IQ, their skills that they have, their raw skills, and then teach them like credit and structuring and stuff like that?
The one thing I'm learning, especially as I progressed over here, is that culture is very important to Bankwell. And I think that's the one thing that I got to take away, because I want to hire people that actually will fit in the system, but also be willing to work, because part of being efficient is sometimes not always being blessed with having 2 or 3 assistants with you, not always being blessed with having the designated underwriter. They're not there yet. So if you're at that scalable shop where, to your point, at that 100, 150, you're not quite there to have.
You're talking about
pods.
divas?
Yeah, we're not there for pods yet. So so maybe that's the key right there.
So you're not ready for me?
Not quite,
Because I can't bring like 6 people with me. Like with Truliant, we came in like super deep with Truliant, but that's funny.
You got a lot of people over there, and that's a good thing. So that means people believed in what you're trying to accomplish.
Well, you mentioned culture a couple times, and I'm curious, how would you define the culture, that you're trying to build in the SBA division?
I think for me, it's seeing what this bank has offered when I walk around and I meet the people there today. They're very, humble, but they're hard workers. They will put, if I'm up there and I'm still there at 6:30 at night, they're still in there working, they want to get the job done. They communicate very well with each other. I want to find those individuals, and I want to build the same internal piece on the SBA level that, everybody wants to be a unit, because it's, as somebody said before, we're all on the boat rowing in the same direction, and that means from closing all the way back into the sales team. How do we all get there? Because at the end of the day, like you said, we can live in chaos, and we do that a lot in our industry, but how do we move ourselves where we have a quality of life associated with that chaos? I love the chaos. To me, I become better. It forces me to think outside the box, but it's very easy to get yourself kind of exhausted because of that.
So people that want to get it done, collaborative, but also balanced with your life, right? So it's not like you're working people to the bone, trying to squeeze every drop of blood out of them.
That's right. Put in that 70 hours as opposed to 42.
Yeah. Like I'm reading Elon Musk's biography right now, and he'll randomly like show up at like a launch site at like 11 p.m. And if no one's there, he'll just start yelling and be like, why is no one working? We need to get to Mars. So you're not going to do that.
I think that's, we've seen that, and I don't know that it's healthy. So,
ooh, okay.
We burn people out. I mean, that's, what do we do to keep, once again, it's back to happiness. The quality of life will push that person to put in the extra hours without complaining.
Right. I think if you build a team in a way that's collaborative and like you just do it right, where people actually care about each other and the divisions aren't like divided between sales, credit, and closing, then like you're not going to want to let your teammate down. It's like, being in the military, right?
But you got to have accountability at the end of the day. I think that's where sometimes they fail, because it's one thing that if I step in and do somebody else's job for them to help them because I'm trying to get to the end result. But if they begin to accept that and want me to do it every time, and they don't take accountability for their task.
See, I don't see that much accountability, honestly, because I feel like it's because you say that because we're talking about let's all play nice and all, but sometimes playing nice and like the culture and everything gets in the way of actual performance, because you don't want to have a hard conversation with somebody who missed a deadline or took way too long to do something or made the same mistake multiple times. Yeah, that's just business though.
Correct. And you got to take that human aspect of, you're not trying to hurt anybody, but you're just setting the rules, the expectations. It's like getting out on the field to play a sport. Everybody knows their positions. Everybody needs to hit that position. If they don't, they need to know the why. Was it them or was it the other person? Was it the quarterback or was it the receiver? And not knowing that sometimes is as confusing as anything else. So we have to define it so that they know when and where they're supposed to be, so that execution can happen. Because at the end of the day, it's not really us, it's the client or the referral source gets hurt. We'll live through it. We just may not get another deal from that group.
Let me ask you this. If you hire a BDO, let's say they're doing 25 million a year in production, and you hire them, and do you feel like the bank should hire them because we like them, we like what they're doing, we like their book of business, their brokers, all that, we want to get all that in here and under our roof. And then when they start submitting deals, are they don't you have to do their deals now because you've just hired them for their deals? Or do you think they're going to come in here and based on what the bank wants, switch up their whole business and go look for some other deals that they hadn't historically had?
Throughout my career, I've seen a combination of those problems. The first is, we as the institution hire somebody with a false pretense of, hey, I'm going to do, this is what we do. And you get here, we don't really do that. Or vice versa, they're selling us on the idea I can do all these things, and then they come here and they can't quite get there. That's where I've learned as a hiring manager is a really fine line that you're trying to figure out, because it has to be some truth to each one of us. It's a partnership. So I try to, when I interview, try to be very honest of what we are and what we're not, of where I've been and where I am now. And then I hope they are telling me the same, because, we can sit there and say that we'll do all kinds of deals, but what does that really mean at the end of the day? It's a foggy area, because sometimes we say yes on one, we say no on the other. Well, did it have more collateral, or did it have better cash flow, or, but how do we teach that? Because at the end of the day, our goal is we need consistency. We need to know we go to market as a salesperson and know that every day that I sit there and tell my referral network, I can do this deal, I deliver on that. But then I also am promising a timeline. So the goal should be, as the organization, is to back up what they educate their sales team to deliver on, both time and commitment of what we're going to do.
Yeah, that's one of the biggest mistakes I see banks make is inconsistent credit philosophy. Tight one day, loose the next day. Oh, we need volume. Let's turn the dial this way. It's hard, competing in the SBA world is hard. It's gotten more competitive. To your point, you got lower pricing out there now. You've got, people using referral fees. By the way, what's up? Is 2% like the new 1%?
I think that it's hard because, I came from a world where it wasn't like that early in, and then it got to that point, or we saw people 3 and 4 points weren't unrealistic. I think that you have to be consistent and have to tell the people why you're asking, or if they want 2 points, what are they going to deliver to you? Is it a good deal? Because the problem is that brokers, I understand, need to be fed. They need to do what they need to do, but are they going to take the losses with you? And the answer is no.
No.
So you got to be able to be willing to stand up for that too and have that hard conversation, because sometimes brokers just need to be fired or they need to be hired back because they're doing the right things. No different than the salesperson, the underwriter, closer. That gets back to its accountability across the whole board. We owe it to ourselves. We as an industry had allowed it to get out of control. But you and I have talked about this in the past. The problem is the secondary market isn't what it used to be.
Yeah, it's down 20% on 10-year paper from what I'm used to.
Correct, but it's even less than that when we were coming out of 20 to 22.
Yeah, we can't all remember. That was a one-time thing.
Right, but I'm just saying it's, a lot of institutions built their model on the fact that this is how much premium income I'm going to earn. Therefore, I'm going to do this and that. And all of a sudden things changed. And, it was because they set the wrong expectations in their budgets.
Yeah, I'm like a 9% guy. Like I like a nice 9% premium.
If you're in that 9 to 10, to me, between 10 and 12 is historically where it's been
for 10-year
forever.
You're right. I mean, you should. I'm wondering why we're not getting back to 12%. I feel like there's something weird going on because with rates coming down, prepay should be going down. Raymond James was 10.5 today on the P+3 10-year, up 0.3, but it should be coming up a point or 2 at this point because this is a great market for investors. I don't know why it's sit still so long.
But I think it's an open market. So certain buyers may pay more of a premium based upon who the institution is.
True.
And they're going to pay less based on the fact that they have less faith in how you underwrite.
But they're all within pretty close, I think.
Still, to your point, it's still within a half a point.
Now, but going back to all right, so we got rates, we got points, we got even credit structures are getting more aggressive. 10% on real estate sounds like ridiculous now.
How dare them want
how dare you expect me to put money down on my real estate purchase? I used to put it out there and people would be like, first of all, you can't do that. You can't market 100% financing for real estate. Now it's just the expectation. But with all that said, what does a bank need to know before they get into the SBA business, like the way you're doing it? National, serious, what do they need to know?
I think, first of all, they need to know what the risks are. You and I know that what I consider large balance, 500,000 and greater, is going to carry a certain default rates. Those that are under 500 is going to carry much higher default rates. Model for that.
Deals are going to be bad. Go bad.
Correct. Model for it.
Right.
Know that it's just a mathematical equation. And I think if the bank and the board understands what the risks are, then you also understand where the premiums are, and that in certain cases you take a little bit more risk because you're going to earn the money for that. It's a risk-based reward aspect of it. So I view it as it's a situation where they have to be knowledgeable. And this was something different. When I was hired, we had conversations and they looked at me as not just a salesperson. I have a credit background. So I think that gave them a little bit more favorable idea of who I was, because I didn't always look at it for just a pure sales perspective. I'm looking at it of, I don't want to take these risks. The second thing that we did was that every transaction has to have my signature as well on it. So everything from credit may sign it, but I have to sign it as well. So I'm taking responsibility for everything that's done.
That's big. You got to almost treat it like your own money, but you're not like a gunslinger. You've never been like that. You're methodical. You're in the weeds. You're probably conservative to a certain extent, but you get the deals done. You remember the deal you helped me with in San Francisco.
Yeah.
But was it? Can we say
Yeah. Well, the funny thing is he came back for another loan.
I heard about that, and I talked to him about it, and I was
Butter.
like, I can't help you with that. It was like construction and stuff. I think, but that was one that I don't think it would have got done if you weren't like in my corner helping me. I mean, for sure it wouldn't have, because I was a BDO on your team at that point. And dude, what was it? First of all, 30 day, you had to turn it around in 30 days. Yeah. There was like a phase 1 issue or phase 2 issue.
We had environmental problems.
Freaking the building was bright yellow. Like, got to get it approved. There was some nuance in the financials. There's more. But he was so happy at the end of it that we got it done.
And I think that was just the difference of me, is that because 2 things, coming as a BDO, but also came in through credit, I looked at things differently as a sales manager, and I wanted to be able to fight for the deal, so that I looked at, I want you guys out there hunting. I mean, that's your skill set. It's finding the next deal. And if you're in the weeds fighting through credit or a thing with closing, then you're not making the money you want to make, nor for the institution. And my job was to make sure I made your life better. And
that was value add. I will say that. Oh, by the way, are you guys, before I forgot to ask, do you think when you're starting up, first of all, when you got there, did they have an LOS? Okay. So when you're starting up a shop, do you think you go LOS right out the gate so that it's all clean? Or do you think you wait until you've kind of built up a little bit of volume and then get an LOS?
That's a hard one. I think for me, I like having, because I'm very anal about things, about how I want things to be done. I like it to be all completed on the front end so that there's no problems down the way. I think coming in after the fact and you're trying to clean things up and trying to get it back to where you wanted it becomes just as much of a problem.
Yeah, the migration to getting on there is a pain. Yeah, I was just curious because there, like 5 years ago, I feel like having an LOS was like a luxury. Mm-hmm. Now everyone's like getting them, and everyone you should. I mean, it's basic stuff. So, okay. So I want to kind of start wrapping things up, and I want to kind of have you look back over your time, because I remember you were at Capital Source for a few years. That was SBLC, right? Mm-hmm. You've been out of the game. You got into real estate development or something like that.
I did that. I did healthcare lending for 5 years.
Were you at GE ever? No. Okay. It was our Capital Source. But anyway, as you look back, like how's the industry, you think, changed? Like what do you see like over the last 10 years, let's say, like going back to, I guess, like around 2014, 2015. Well, were you in it back then or no?
Well, I think for me, what I saw the difference when I first got in, I was at it's called Zion Small Business Finance at the time. It was a offshoot of ITT Finance team back in the late 90s that they built a national platform. I think the difference I saw, at least then, I was exposed to what a national footprint looked like. Then I went to a bank in Texas, Bank United, where we were just kind of local. And then the dynamics changed. We did a lot of volume. We went from, and then we became national, brought on a group of team that came over. We went from number 26 to number 6 within 12 months, something like that. So
in the country.
Yeah. Wow. To me, I've been fortunate to be in different kind of looks, then like you said, we were at a more of a non-bank controlled by a private equity firm. Then Capital Source bought us out, which gave us more lifeblood to be able to continue. But when that happened, we also changed the credit culture of the deal and types that we wanted to work on and do changed. So I think, learning to be adaptive is the key, because we're seeing things change so much. For me to be doing this as long as I have, I think the difference is that I've always just looked at, okay, what is the next technology thing? What's the next opportunity that we can see? Like you're talking about, is there vertical? Sometimes it was, what is the next vertical? What's the next thing to jump into? Because, we didn't see, in my opinion, 10 years ago, business acquisitions, non-real estate were the key. Today, that's the key. Yeah. If you don't do some of that stuff, you're not going to survive unless you're going to portfolio or put a fixed rate out there or be an enterprise where you are a certain type of lender and that's all you do. You got to be really good at it, and that's hard. If you're trying to be a journalist, and can you chase that? I think we've evolved to a point as an industry that you got to be adaptive and you got to be willing to take on almost any kind of deal. If you really want to be in that top 25, you want to be in that top 15 over the next 5 years.
That's what I would say is, so much has changed. Everything's changed, but I want to focus on the credit. the way I was sort of taught by someone we both know was that business acquisitions were extremely risky. Doing a deal without a 10% seller note was just not even, there was no pre-screen that ever went through unless it was like direct industry experience or franchise or the manager buying the business or whatever. But your typical business acquisition, someone buying a business, they've got relevant experience, right? None of those ever went through pre-screen without a 10% seller note, like, which is good. I huge fan of seller notes, but that was one thing. Needed 2 years of 1.3 DSCR. That's something that is conservative. It's also a good idea. I like lending to stable businesses where it's like 1.3. But then also you needed like really good experience too. So it was like, all right, so they want 10% down, 10% seller note, good experience. Fine, checking all the boxes. Anyway, cut to today. There's people with no money buying businesses, seller notes as equity injection, 1 year of DSCR, 5 million, no collateral. Everyone's doing it now. It's like, what is going on? So that's, to me, the biggest difference. It's just people are willing to take on more risk, I think.
Well, and to your point, they're also open-minded in that sense of, they're looking at the 5 C's of credit and they're leveraging up and saying, okay, I can be comfortable with these 2 or these 3, which we didn't see in the past. But I think that's, like you said, our mentality. So many people throughout their life cycle thought, oh, I'm lending on real estate and real estate's the best thing in the world. But we've also seen real estate get cut in half because of economic conditions. So was that real estate really worth it to you? Or when you had to go and take it back, was that really the right thing to do? I think, for me, because I came up through asset-based lending to begin with, cash flow is king at the end of the day. Numbers don't lie. If you got good cash flow and then you can interpret kind of and believe in what the management buyer can do for you, then I think that eliminates a lot of the risk. Just because they don't have money doesn't mean they're not going to be capable of making money. I look at it as what is their belief system? What's their goal here? Because a lot of people too, it's a greed factor. You get into the business and all of a sudden I'm making money. I want to go spend it all. Next thing you know, the business is going down or they're mismanaging things. It's knowing that person is capable, that when things get tough or if there's a collection of receivables that need to be done, are they out there doing it? Or they're holding themselves accountable. Because all the real estate in the world, yes, I can go take it down, I could do it, but at certain points in time that real estate's not going to cover everything. We're here to do a good loan with the expectation it's going to repay us at the end of the day. That's what we're in business for.
Well, that's a great place to end it because cash flow is king. And I fully agree with that. And I think that you nailed it, Michael. And thank you so much for joining the podcast. It's good catching up as always. And I wish you luck with this new gig.
Thank you. I appreciate it very much. And good luck with you guys.
All right, that's it for this week's episode. If you want more SBA content, you can sign up for our monthly newsletter and check out our sister shows, SBA Today and the BDO Show. We'll leave a link in the show notes. And don't forget to subscribe to this podcast so you never miss an episode of The Art of SBA Lending. Ta-ta.